Paulsen joins us now from Wells Capital Management out in Minnesota. Good morning, sir. I want to go first to the economy and then to equities here. Let's bring up net savings. This is our deficit savings of the government, our savings of individuals, and our savings of our corporations, which is really big, lots of profit there. And Jim, we've just been in a chronic shortfall of savings. Is there a risk here that we save too much and slow down this recovery?
Well, I think it's possible. You know, we have too much frugality, if you will. But I'll tell you what, Ty, I think we're doing better on that score than you might think, in the sense that I know that corporations have $2 trillion of cash. But if you look at real residential, real non-residential business spending in this recovery, so far in this recovery through the first 2 years, it's up far more than it was in either the 90s recovery or the early 2000s. If I look at the household sector, there is more evidence of frugality there, but we are starting to see the first signs of some bank loans, even consumer bank loans, and certainly consumer credit reemerge a little bit. So I do think that if we continue to make progress on the job front, Tom, we're going to see some of that old spend till you drop character from the consumer.
Well, that's the point here, and a lot of research notes today from the relative optimists like yourself saying, wait a minute, here's the data. Forget about diffusion indexes, which measure behavior. Forget about mood. Here's the raw data. And is it your observation that consumers are spending in this third quarter?
Oh, I think so. I mean, I think at least we started off July very, very strongly here with the personal consumption numbers this morning, the retail reports that we've gotten. I think the GDP numbers in the first half, Tom, the idea that we grew only 0.7% in the first half really scared people, that we stalled. But as of the revisions last week on GDP, the gross domestic income report that came out showed that real income growth in the first half grew almost 2%. That's another measure of growth in the economy. And I would suggest that's more correct as far as the economy slowed down, but it's still growing around 2%. And there's a lot of data that supports that, including the continuation of retail sales here.
Okay, here's average hourly earnings, folks. This chart's a little out of whack, but we're going to use it. Real average hourly earnings. And to be kind, it's been weak, to say the least. And Jim mentioned some percolation, some positives. Jim Paulsen, how should we measure the nation's wage growth? What's the best way to do that?
Well, I think the wages and salaries put out every month in the personal income report is a good thing to keep an eye on, Tom. But you know, the average hourly earnings, the growth rate slows in most recessions and then slowly recovers, and that's our pattern of the average wage rate growth in this recovery is a little different than what it was in the last recovery, for example. It fell quite a ways and then it was slow to recover. So you got to also remember that the core inflation rate's just barely over 1.5%. So there's still some net real growth in wages relative to core inflation. And I do think that although it's slow, I still think, you know, job creation this year, non-farm private payrolls are up about 165,000 a month, and that's up a lot from the average of 98,000 a month last year. So as bad as it seems this year, we're still making progress from where we were.
The vector's moving in the right direction. This is a great chart, too much information, and it's courtesy of Jim. He loves the Minnesota Twins, Paulsen. Here it is, retail wins amid the gloom, and this is a comparison of the retail stocks to the S&P 500. Not only is it at a record high going back to 91, but look at that persistence, folks. Jim, I don't think the American public understands how Polo and the rest of them have really done phenomenally well.
Yeah, I know. It's very interesting, Tom, that chart to me, and that we've got this view that the consumer's dead, it's almost on life support. You know, we've slowed to zero growth in the first half. And here we got the retail stocks going to new all-time relative highs. I think that's a good signal that maybe the undertow fundamentals of the household sector are holding up far better than people fear here, and I think we're going to find that out in the weeks and months ahead.
Jim, what other areas do you like here? I mean, industrials, Dean Dray's going to be on a bit. He's marking down his earnings a bit on the industrials. Is there one sector that's particularly attractive right now? I
like the industrials, Tom. Here's what I do as an investor right now. I take advantage of this panic. by letting people have some of the safe havens that everyone wants at really high prices. So in the stock market, I'd let them have some consumer staples and some utilities and some healthcare stocks if they feel secure in that at these elevated prices. And I would buy up the stuff everyone's throwing away right now. And one of those is industrial stocks, technology stocks is another one, emerging markets. Those, I think, have been beat down to really low values. And if we come out of this and we don't recess, then I think safe havens are going to underperform, and the cyclical, economically sensitive areas are going to be places you want to be.
The paper of Jackson Hole, Jim, on U.S. debt. This is Stephen Cicchetti, folks, formerly of Ohio State and Brandeis, now at the Bank of International Settlements in Geneva, in Basel. The real effects of debt. The debt problems facing advanced economies are worse than we thought. Given government benefits, aging will sharply raise public debt to much higher levels. Jim Paulsen, this debt issue is front and center. How do you disconnect your market optimism from the reality of our fiscal gloom?
Well, a few things, Tom. One is people mention the gross debt to GDP ratio, which is about 92, 94%, something of vicinity. But the net debt, which is if you exclude the debt that's held by intergovernmental agencies like the Federal Reserve, is only about 65%, up maybe 9 percentage points from where it was in the mid-90s. So I'm not sure it's anything like Greece here in this country. Secondly, the debt service burden, which is really the burden that determines whether you're financially insolvent or not, principal and interest payments as a percent of growth, is almost at a record low right now of around 3.5%. It's one of the lowest levels ever in our history. And that's because the rate structure is so low and near zero on the short end. So I do think it's an issue and a problem. But you know, Tom, long before this crisis, we knew we were going to have to cut health care and Social Security benefits, and we're going to continue to do that.
Thanks so much. Jim Paulsen, thank you so much from Wells Capital Management.